What's up, everyone? My name is Ale. Welcome back to my world of stocks, and welcome back to my 3 stocks on sale series for the month of October 2023. Now, as you guys know, in each episode, I would normally choose one low risk, one medium risk, and one high risk stock to bring to your attention. But because this is the month of October, the month of Halloween, I'm actually going to turn up the scary risk meter all the way up to high for every single one of these stocks. That's right. Each of these 3 stocks is going to be only a high risk option. So if you're only looking for safer investments out there, then you may want to turn away because each of these stocks has been chopped in half. They've lost more than half their value. And so they are a bit scary. But if you're a fan of horror and you want to see some brutally beaten down stocks that are high risk, but I feel have a lot of turnaround potential, very high potential in my opinion, then you may want to stick around because we're going to have a lot of fun in this one. But let's not waste any time. Let's go ahead and jump into this list of 3 high risk, but also very high reward potential for the long term. Let's jump into it. All right, so for option number 1, I'm going with PayPal, ticker symbol PYPL. This is a digital payments giant that was originally spun off from eBay, which is still very heavily used on the platform to this day. And of course, tons of other websites around the world use PayPal as well, where they provide digital payment processing services to both merchants and consumers. Where they're able to collect fees from every transaction. And by not having to input your credit card information into every new website, but instead just simply storing it in your PayPal account, it not only adds security and peace of mind to your transactions, but it's also much more convenient. And that's why the platform has really attracted more than 400 million active users, which is very impressive. Plus, they're the parent company of the smaller Venmo, which also has grown into a very popular digital wallet too, especially here in America. But despite all of that success, the stock has been absolutely decimated in the past couple years, falling from a high of over $300 a share, crashing by over 80%, down at just the $50 range today. And that is really a crazy fall for what is the world leader in digital payment services, according to Datanyze, where they still hold over 40% market share globally and close to 60% share in America too. Having said that though, the reason why I've always considered PayPal to be higher risk, and really the reason why I've always just been a little too afraid to purchase it myself, is because I just don't see much of a barrier to entry for what they do. In fact, huge rivals like Google Pay, Apple Pay, Alipay, WeChat, Visa, and more are often left out of these market share analysis reports for being either too different or maybe catering only to certain demographics and regions, like in the case of some big Chinese players. However, I still think that investors should be aware of these giant whales that are essentially lurking in the same ocean, because at any moment, they could really choose to offer similar services that would give PayPal some trouble, and they certainly have the funds necessary to do that because of their huge sizes. Still, this isn't really the reason why the stock has even crashed in the first place, as that honor really goes to their slowing growth rates. See, PayPal was long valued as a growth-oriented stock, but coming off of the pandemic, their user growth has dwindled down from over 20% growth to just about flat last quarter. As a result, revenue growth also took a hit, falling from around 20% growth in 2020 and 2021 down to the single digits going forward. As sizable as those drops are, though, my opinion is that this is yet another classic example of overselling a tech stock just because it's having a hard comparison to the pandemic years. I mean, for crying out loud, their free cash flow has actually increased by over 30% since before the pandemic to last year, yet the stock price has actually decreased by more than 50%. How does that make any sense? You're now talking about a valuation here that is over 40% cheaper than the sector on a PEG ratio basis, and it's why PayPal themselves are buying billions of dollars of their own stock back. And I gotta say, I agree with their decision, considering how large the market is, with mobile payments alone still growing by huge amounts of over 30% a year. It's expected to reach close to $20 trillion by 2030. Well, I just think they have to be buying their stock at this cheap of a price while they still can. Again, it's not a stock without significant risk, but I feel that Wall Street is incorrectly valuing them as more of a growth oriented stock, when in reality, coming off the pandemic, it's really changed into more of a cheap kind of value type of stock. And even from a growth perspective, I mean, I know users have stalled, but they're still finding ways to make more money over time. So I think it looks very attractive as a turnaround play at these levels. I think it looks dirt cheap, and I think it easily deserves a spot on today's list of high risk but also high reward potential type of stocks. All right, moving on though to the next option. For this one, I'm picking the Chinese version of Google in Baidu, ticker symbol BIDU. And the reason is very simple, because while I would love to choose Google instead, that would obviously be considered low risk. So instead, I'm going with Baidu as the higher risk alternative, which is a little hard to see on this chart here, but their stock price had previously reached a high of over $350 a share before crashing all the way down to just the 130 range today, losing more than 60% of its total value. Leaving behind though what I think is a dirt cheap valuation considering what you get in return, which is the largest, most dominant search platform in China with over 60% market share, whereas the next closest competitor in Microsoft only has 17%, while the giant Google is all the way down at the bottom with only less than 2%. How crazy is that? Baidu also dominates online advertising with other giants like Alibaba and Tencent that together make up over half the entire Chinese market, and they're the fourth largest cloud computing platform as well. All of these, by the way, are markets that China would love to dominate in the future, and I think Baidu will play a huge role in that. But none of them stand out more to me than artificial intelligence, because whether we choose to admit it or not, we all know that China has huge ambitions for being a global power leader, specifically by 2050, according to some of their estimates. And one of the biggest ways to do that is going to be by leading in technology, especially AI, which is projected to be worth trillions of dollars in the not too distant future. Now, I'm not here to really talk about the dangers of Chinese dominance or argue that point, but rather I'm just looking at this from a stock market investing perspective alone. And in my opinion, there is no other company in China that I think stands to benefit more from their AI ambitions than probably Baidu. I mean, Alibaba and Tencent are definitely up there, but not much else really comes close to these companies. And the reason I feel this way is because Baidu already has the most cloud AI market share in the country, which is a position that they've held for 4 years in a row now, according to the IDC. They have just about the most AI patents of any other company in the world too, almost tied with Tencent at over 9,500 of them since 2021, which was more than double, by the way, of the size of Google. That's pretty crazy. And since then, they've applied for over 22,000 AI patent applications and are already using over 90% of the patents they hold, implementing them into various products and services, including their Apollo autonomous driving platform, which was the first to receive commercial robotaxi approval in China. And by the way, that's another market that will experience huge growth too, as more than half of all mobility travel is expected to be driverless by 2030, with Baidu leading the pack according to S&P Global Research. But they also make their own AI chips already that compete with NVIDIA. They of course use AI all across their giant cloud and search and advertising businesses, and they've even launched their own generative AI platform too called Ernie, which competes with Microsoft's ChatGPT and Google's Bard. And yet despite all this dominance and all this tremendous future potential, the stock crash has left the stock dirt cheap at a valuation that is over 70% cheaper than the sector on a PEG ratio basis. Yet financially, Baidu is just as strong as ever, doing record operating cash flow in the past year and almost the same free cash flow as before the pandemic. Revenue growth has been spotty and slowed down to just a single-digit rate expected in the next 2 years, but I think that'll accelerate in the future once the Chinese economy really recovers, which is currently going through a horrible time. Again, the stock is very high risk. I mean, just being a Chinese tech company is going to inherently carry a lot of risk within it just from that alone. But for the purposes of this month's video, I actually feel that they fit the bill pretty nicely here as a stock with huge turnaround potential. And that's especially the case if the US and China can avoid any major conflict in the future. And if they actually get along and American investors aren't screwed over, I think Baidu could soar from here. And it's one of my favorite kind of speculative stocks to hold myself. All right, that will, however, leave us now, though, with the third and final high risk stock of the list. And I think another great fit here would be the meat and poultry giant Tyson Foods, ticker symbol TSN, which has now fallen from over $100 a share down to the $40 range, so losing more than half their total value. And here's the thing about Tyson. It's essentially a commoditized, kind of cyclical business in a way that goes through ups and downs all the time, depending on things like meat and poultry prices, the cost of feed, various production costs, and just the overall macro state of the economy, which right now happens to be one of the biggest recurring dips that we've ever seen in the stock, maybe the biggest. And if history is anything to go on, we usually find huge support here at around the $50 range. Now, clearly we're going below that, and it could for sure go even lower from here, but I personally feel that the stock will recover back up to an all-time high over the longer term, and here's why. The fall has had everything to do with the macro environment, where inflation has raised costs while also weakening demand for their higher margin products among consumers, and it's created this kind of perfect storm that sent their cash flows crashing into the ground for the meantime. As the CEO recently pointed out, Tyson is experiencing a highly unusual situation where literally every part of their business is currently in decline. But my argument is that rare occasions like this don't last forever. In fact, in the past year, we've seen one of the sharpest inclines to inflation in history, but do you really expect that to last forever? We've also seen the sharpest rise in interest rates, but do you really think that'll last forever? The economy is also in the toilet right now, and everyone seems to think a recession is right around the corner if we're not already in one, but do you really think that'll last forever? Well, if the answer is no to these questions, then Tyson stock looks super attractive here, and I really think the CEO summed it up best in the most recent earnings call, where he said, "We've been through market cycles before, and I'm confident that we have the right strategy, seasoned leadership, and team members in place to emerge stronger from this one too." And that's really a feeling that I fully agree with myself too, because guys, we're talking about what is already the world leader here in meat and poultry, which I think gives them, a huge amount of experience and, like CEO said, seasoned leadership to get through these kind of struggles. But that's also just an overall broader market that I think is never going to go away. And in fact, I still see more growth opportunities in there for them too, in things like frozen foods, air fryer ready foods, and even meat alternative foods as well. And every single year, we still see total sales that are breaking new record highs, which, by the way, leaves probably the cheapest price to sales ratio that I've ever seen in the stock at over 40% cheaper than their own 5-year average and a whopping 70% cheaper than the sector. That's pretty huge. And while the dividend, I would say, is at least at some risk of being cut during these current struggles, I still think that it'll either stay or at least come back shortly after they recover. So I would still include it here as a pretty strong pro, since it's now yielding close to 4%, which is the highest I've ever seen in their history, even higher than the stock crashes of the Great Recession and the 2020 pandemic. So I've been picking up a few shares myself, and I'm going to continue to do so in small amounts the more that it falls, because I just see a good value here. But let me know what you guys think. Do you agree with any of the stocks that I chose for this month's video of a high risk, high reward potential type of stocks? And if not, what stocks would you have on your list? I'd love to hear your thoughts, because I may include it in a future video. So let me know down below what stocks you're liking out there. But thank you for stopping by. Thank you for all the support, my friends. I really appreciate it. And I will catch you in the next video. All right, take care, everybody. Bye-bye.